So this is our Chapter 11 lecture, Part 1, and this is on corporations. In this book, Financial Accounting, we've been talking about corporate form as a entity. There are other forms for business, one of which would be a sole proprietorship, in which case one person is the company, indistinguishable from that person. Another form of enterprise would be a partnership in which two or more people join together to form a company. Corporations are what we've been looking at in this book, and corporations have some unique characteristics to them. And let's go kind of through those real quick. I think there's a more detailed discussion in the book, which you can go through at your leisure. But first of all, it's important to note that while all companies are separate economic entities, apart from their owners, the corporation is actually a separate legal entity apart from its owner. Now that's very important because what that means is that liabilities of the corporation, so liability is limited in this case to the company. So for instance, in the corporate form, if something happens in the company and the company gets sued, then the person going after the company can only satisfy the claim from the company's assets. They cannot go to the shareholders' personal assets. And that's different than a partnership or a sole proprietorship. In a sole proprietorship, if the company were to do something wrong and a lawsuit were to be filed, the claimants could potentially go after not only the assets of the company, but the assets of the owner personally. Same thing in a partnership. The partners could be personally liable for the debts of the company. But in a corporation, that's not the case. The shareholders are not personally liable. So that's a huge benefit for this particular form of company. So for instance, if you were a shareholder in a company, shareholders in a corporation, that corporation was somehow sued, was taken into bankruptcy, and that corporation's assets were not enough to satisfy those claims, they could not come back after you personally and have a claim against your personal assets. So any investment that you make in a corporation's stock is the amount that you could lose. You cannot lose more than the value of the stock. So very important that corporations have a limitation of liability. It does not extend beyond the corporate shell. It does not extend to the personal assets of the owners. On the flip side, the corporation pays its own taxes in the name of the corporation. So for instance, Apple pays taxes as Apple Incorporated, but any dividends that Apple might pay to its shareholders are then taxed at the shareholder level. So if you're an owner of a corporation, the corporation pays tax on its earnings, and then when the earnings are distributed to you, then you as a shareholder pays taxes on those earnings a second time. So really, there's a double taxation that exists for corporations. And that, of course, would be a big negative. So while there's a limitation of liability that's a huge positive, the double taxation is, of course, a huge negative. In terms of organization, corporation is governed by charter, by bylaws. It's a much more formal organization, and it requires certain filings within the states in which business is done. There's more information again in the textbook that you can look at, but it's a more difficult organization to set up Sole proprietorship can be set up basically in some ways immediately, but a corporation does require certain filings and, of course, fees and potential legal costs to establish itself. Ownership. Corporations can be public, in which case the shares can be traded on a public exchange. They can be private, in which the shares are only exchanged among private investors, or perhaps not subject to transfer at all, or under very limited circumstances. They can be one shareholder can be a corporation, or any number in excess of one. So you could have a corporation with just one shareholder, or you could have a corporation with millions of shareholders in the case of some large publicly traded companies. In terms of the governance, the way it works is that the shareholders put them here. They elect what's called a board of directors. And the board of directors are basically who oversee the decisions of the company. They act in the interests of the shareholders, but they make the major decisions of the company. They're the ones that hire the senior management of the company. So they hire the senior executives of the company. And then, of course, from there, senior management hires the rest of the employees. But it's important to note that the board of directors is the key decision-making body for all the major decisions. So if there's small decisions that need to be made, employees will make those. If there are relatively major decisions to be made, the senior management makes those. But if there's decisions that affect the shareholders of the company, for instance, say paying a dividend, or perhaps purchasing a company or selling the business, any major decisions have to go through the board of directors, and in many cases are then approved by the shareholders themselves. So the board of directors is really ultimately who is responsible for the actions of the company. So that's obviously a key role. Some of the board of directors are composed of the senior management, so maybe the CEO and the CFO. And then many of them are independent members that act in an independent fashion, that are not aligned with senior management, but act again in the best interests of the shareholders. Again, worthwhile checking the book for more information. The concept of ownership, remember what's happening here is that a share of stock, it represents ownership of the company. The share of stock is purchased by the shareholder, and that represents an ownership interest in the company. And in most cases, that ownership interest is transferable. So I can become an owner of Apple Incorporated by simply going into the marketplace and purchasing a share of Apple stock. And when I no longer want to be an owner of Apple, I can transfer or sell that stock to someone else. And the question is whether I've sold that stock at a gain or a loss relative to when I purchased it. So let's look at the accounting for corporate transactions. And really, the accounting is no different for corporations and for any other type of company in all respects, except for transactions that affect the equity section of the balance sheet. And some of these we've already gone through, but we're going to go into a little bit more detail in this chapter. But first we remember the owner can make an investment into the company. And the way that that's done is through the purchase of common stock. And that is going to be classified in a new category, which is we're going to entitle in a broad category called paid-in capital. And I think we discussed this maybe in chapter 4. So that's the first category. In addition to making investments, the owner can also make withdrawals. Those are called dividends. We've talked about that before. And of course, the other thing that happens is we close out revenues and expenses, which are net income, and those also go into the equity section. And both of those combined are going to go into a section entitled Retained Earnings. And that's also the name of the account that's going to be used. So in paid-in capital, we might have various different accounts. For instance, common stock, preferred stock, other types of stock accounts, and some other additional accounts. In the end, we're going to close out our dividend and our revenue and expense accounts into just one account called retained earnings. But we're going to eventually have really sort of two sections for the time being. We're going to have two sections in our equity section. And we're going to have a third section that's going to be what's called, if we actually go out and repurchase stock that's been in the marketplace. So this is kind of a new concept. So we're going to repurchase stock. So we've already issued stock, but as a company, we're going to repurchase stock. And this is called treasury stock. Treasury stock is going to be its own individual category also in the equity section. We'll just abbreviate that. So really 3 different things going on, 2 of which we've talked about before, paid-in capital, retained earnings, but now we have treasury stock, which of course would be a negative. It would be a reduction of equity because we've repurchased the stock that we've previously issued. We've reduced the amount that's been invested. So it's almost like a dividend. So let's take a look at an example of the issuance of stock. Now, again, I would refer you back to the book. We can look at, there's different types of stock that can be issued by a company. The 2 most likely are common stock or preferred stock. Preferred stock is a stock that has preference as to dividends, and also in the event of a bankruptcy or liquidation, it has the first priority. Common stock is what basically would receive as the residual. It also may pay dividends, but it does not get the first dividends. And in liquidation, it would be the last to receive any proceeds from the sale or liquidation of assets. Preferred stock generally is purchased for the dividend. Common stock is generally purchased for the price appreciation. And common stock is by far the most common in the marketplace. So the example here is we're going to issue 100 shares of common stock that has a $10 par value. We're going to issue it at $12 a share. So what we're going to do is we're going to debit cash, and for the amount we're going to receive for each share $12, so it's 100 shares times $12, and that's going to give us $1,200. We're going to credit common stock, and we're always going to use its par value. Par value here being $10 a share. So $10 times 100 shares is $1,000. And the difference is going to go to what we're going to call paid-in capital. I'm just going to abbreviate here. In excess of par value. In excess of par. And so that'll be the extra $200. Each one of these is going to be a separate account, and we'll come back and talk about this in the next video.